By late 2021, the cryptocurrency market was no longer a frontier. It was a roaring metropolis of capital, innovation, and belief. Bitcoin breached $68,000, Ethereum brushed $4,800, and the combined value of all cryptocurrencies surged toward $3 trillion, a figure that would have seemed impossible only a few years before. Screens across the world glowed with green, and for a moment, the digital economy felt unstoppable. The atmosphere was unlike anything traditional markets had seen in decades. This was not the slow, measured growth of blue-chip stocks or the predictable yield of government bonds. This was acceleration without precedent, double-digit weekly gains, token launches that multiplied tenfold overnight, and fortunes made in months instead of lifetimes. Analysts on mainstream financial networks spoke of paradigm shifts and generational wealth creation. For many, it felt less like investing and more like standing in the path of a hurricane made of gold. From New York penthouses to small-town cafes in the Philippines, conversations swirled with the same energy. Teenagers debated market cap rankings, retirees tracked portfolio apps with morning coffee, and online forums thrummed with strategies, rumors, and triumphs. Stories of a friend's cousin who had turned a modest stake into a small fortune spread like campfire legends. In the minds of many retail investors, risk had dissolved into inevitability. The market only went up. The numbers supported the illusion. Trading volumes on major exchanges set new records daily. Decentralized finance protocols locked in billions in total value, promising annual yields that traditional banks could never match. NFT marketplaces buzzed with activity, where pixelated art and digital collectibles sold for prices rivaling luxury real estate. Crypto derivatives, leveraged futures, and perpetual swaps magnified the potential returns, and with them, the potential dangers. Yet the seeds of fragility were already sown. Liquidity, that invisible oxygen of markets, was abundant, not because of the underlying productivity of the crypto economy, but because global interest rates hovered near zero. Central banks, still countering the economic impact of the pandemic, had flooded financial systems with capital. Much of it found its way into assets promising the greatest returns, and in 2021, that meant crypto. Economists watching from the sidelines noted the familiar pattern. Hyman Minsky's stages of a bubble, displacement boom, euphoria, profit-taking, and panic seemed to be unfolding in real time. But to those riding the wave, academic warnings felt like the mutterings of those too timid to join. In Euphoria, skepticism is an unwelcome guest. The cultural moment deepened the conviction. In sports arenas, cryptocurrency exchange logos shone on scoreboards. Celebrities released NFT collections. Politicians spoke of making Bitcoin legal tender. Venture capital firms raised billion-dollar funds dedicated solely to blockchain innovation. The line between finance and pop culture blurred until the market felt less like an industry and more like a movement. Retail investors, flush with paper gains, began reinvesting aggressively. Many took on leverage, borrowing capital from exchanges to amplify trades. Margin levels climbed to historic highs, turning the market into a glass tower. Dazzling to look at, but fragile under stress. New coins launched daily, and many were speculative at best, fraudulent at worst. Yet demand rarely faltered. Even the most improbable projects found eager buyers. The boom's emotional core lay in the belief that crypto was not merely an asset class, but a new order. Decentralization promised freedom from the control of central banks and governments. Smart contracts hinted at a future where trust was coded, not negotiated. Digital scarcity, enforced by blockchain consensus, was hailed as the foundation of a more transparent economy. The narrative was powerful. And narratives, as every investor knows, can be more binding than numbers. But beneath the exuberance, tremors began to stir. Bitcoin's sharp intraday swings grew more frequent. A few high-profile hacks shook confidence. Stablecoins, the market's anchors, occasionally wobbled under pressure. Regulatory warnings, once ignored, began to multiply. The U.S. Securities and Exchange Commission probed token offerings. China intensified its crackdown on mining. Still, these events were brushed aside by most as temporary squalls in an otherwise clear sky. It was easy to believe in permanence when the tide was high. The river of debt, in the form of leveraged positions, swelled quietly beneath the surface. The weather of wealth remained sunny, but clouds were forming far beyond the horizon. In the invisible architecture of markets, small fractures were beginning to appear. For now, the numbers kept climbing. Portfolio trackers displayed wealth that, for many, was larger than anything they had ever imagined. Screenshots of profits circulated online like trophies. Even cautious investors, wary from earlier cycles, found themselves swept back into the current. It was, after all, hard to resist the sense that one was living through a rare and historic opportunity. The kind that comes only once in a lifetime. But history's rare opportunities often come with unspoken costs. The pendulum that had swung so far toward optimism was already, imperceptibly slowing. And when pendulums slow, they do not stay still. They swing back. The euphoria of late 2021 was the crest of the wave. Beneath it, the forces that would drag the market into its deepest winter were already at work. Quiet, patient, inevitable.